So I just watched this video that my dad just put out about taking a sizable hit in his portfolio for the month of March. And you can check him out at Best of US Investors here on YouTube. He's got a real popular channel. He's got some really insightful content. And honestly, it's really good. And for my dad, I mean, shoot, the guy's older than most people who are on YouTube, and he's putting out incredible content. So go check him out at Best of US Investors. But here's the thing that got me to creating this video today about losing money. People justify things like losing money as it's a long-term investment. And after 20 years as a financial advisor, which as of April 1st, I'm officially retired, sold my business to my business partner, and now am full-time YouTubing. So you're going to see more content from me, but you're also going to see more content that is deeper in explaining about markets and individual positions, because in the past, I couldn't do it because of licensing issues. Anyhow, he puts this video out, and I've watched part of it, and maybe he explains a little bit further, but I want to address this losing money concept. If you listen or read about professional traders, the idea of writing it out doesn't exist. It is, I don't lose money. I don't write it out, because you never write it out. When you lose 10%, you've got to get 15 to 20% returns just to get back to zero. And when markets turn on you, or the cycle or economic cycle changes on you, you may not get back to zero for a number of years, as we saw back during the housing crisis, back during the tech bubble crisis. When stocks go down a big percentage, you've got to make up a bigger percentage just to get back to zero. So this is where risk management really comes into play. And I think this is one of the biggest missing pieces in portfolio management. I'll give you an example. There are stocks that people believe in: Amazon, Apple, Facebook, Google, the FANG stocks. These are stocks that have had an enormously great year last year. Amazon, so-so. If you bought it in June or July, you're pretty much going like this, sideways. You really aren't making money if you're buying and holding it. And maybe someday they'll be bigger and better, and it'll be a $6,000, $10,000 stock. That's a what if, and I don't live in a world of what ifs. It is or is not. And if you're negative in a position, you're negative. That's the end of the deal. So how do you risk manage a portfolio? How do you allocate into it? Well, here's my theory to it. Equities, stocks, I take a 6% max position in a company. I determine where my risk range is in this. Where is the bottom side of that stock trading, and where is the potential top side of that? And what I try to do is I allocate more towards the bottom side. And if you want to know more about how to determine risk ranges, shoot me an email at taglivingloud.com or taglivingloud@gmail.com. I'll put it in the description below, and I'll write up a paper and I'll send it to you on my theory on how to allocate portfolios. So what you do is you determine your risk range. Once you've determined that, you start to allocate assets towards that lower end of that range. So let's say you got a stock and it's trading it's got a risk range of between, say, $9 and $12, okay? So you're going to allocate maybe 0.5% to 1% on the low end and build that position as it bounces around that lower end of the area until you're up to that 6% allocation. As it rises and gets to that that high end, that $12 price target, so between 9 and 12, if that's your area, then maybe you trim off a little, maybe take 1 or 2% and trim off the gain you have in that position. So if you go from a 6% allocation to it becomes a 12% or a 20%, peeling off some of that allocation, taking profits, there is no problem in doing that. So as you get to the higher end of a range or the higher end of that euphoric spike, you start to trim down your position and put money in cash so that when it does come down, and it will come down, it always does. I was just talking to my daughter's boyfriend, who we were talking about a 3D printing company, DDD, I believe it is. It went like this, and now it's come back down. It's retraced a big chunk of that spike. It's going to happen. So if you risk manage around that, and you allocate in on the lower side, and as it hits the top side, you peel that back to the original allocation from, if you got a 12% position in it from the original 6%, or a 15 or 20, you peel it back to 6%. That way you've taken profits. You put it in your cash, and when it retraces, and if you believe in the company long term, you can come back and reallocate to that original 6%. Because if you bring it back down from 12 to 15% gain or position from 6%, and you peel off the between 6 and 15% and bring it down to a 6% position, and when it falls and it becomes, say, 3%, you can reallocate more money to it and bring it back up to a 6% allocation, and as it moves higher, do it the same way. This is how professional money managers do this. Doesn't mean when you sell something that you don't believe in the company anymore, or that you've thrown in the towel, that it's over, you're never going to buy it again. No, this is risk management. Because to lose 21% of your gains, or 20% at 1% of your portfolio, means you have to get a 40% return just to get back to zero. Don't do it. Recently, I read this book, and I did a review of it on another video, and I'll put that in the comments or the description down below. But it's called The Unknown Market Wizards. And what you learn in this book is these professional traders, oftentimes, they put their stops. This is the number one thing they talked about, putting their stop loss order in right after they purchase it. And a lot of these guys are trading future contracts or option contracts, but even the stock guys said, I can't lose money. If I lose money, I'm out of the game. So a lot of them will have tight stops, like on future contracts, which move really fast, and they're in them for a very short period of time oftentimes. They'll put like a 2% stop below where they bought it at. In some other cases, in the stock guys, they said 7%. Below where they bought it at. It gives the stock room to move around in that range, but long term they have a belief that it's going to go higher. And what I have started to adopt is, when I buy a company, I have a reason and a theory behind that company. I have a range. I have a trade range, a trend range, and a tail range. And that tail range is the highest that stock has been in the last 3 years or so. And I have a formula that I can go out and pull that data and determine what that is. And once I've determined that, it also helps me calculate what my potential return on that position is. So if I've got only, say, a 5% probability of a return, I'm not going to allocate a lot of money to it, because there's not a lot of upside. But if I have a 25 or 50 or 75% return probability based off where it is today and where it has been, well, then I'm going to allocate more towards that, because I'm going to get a bigger return. This is all portfolio management. This is all risk management. At the end of the day, you should be upset if you lose a big portion of your portfolio. If you're not putting stops in, if you're not determining where the stock can go over the next long term in my world is 3 to 6 months, then you need to adopt this, because losing a major chunk of your portfolio because of the month of March, which is historically not a great month anyways, is not acceptable, and you shouldn't accept that. Be a better risk manager. Be a better investor. I'm not a trader, I'm an investor. but I risk manage because at the end of the day, I'm going to need this money that I'm investing. I know at some point we're going to have another 2008, another financial crisis, another tech bubble. We're going to have something. Because if you really do the digging and do the deep dive on what's happening, we're more leveraged than we have ever been. Corporate debt is $11 trillion, and you have a rising 10-year yield rising against it. And if you have a loan that marks to market on a monthly or quarterly basis, you're paying more, which means you have to make more as a company. Well, if you don't make more as a company, you start to default. Anyways, so I don't want to go out on a tangent about that, and I'll do that in another video. But my point of all this is build a good risk management process. If you would like more information about this, I will write a paper about it, which I'll be more than willing to send out to you. Just shoot me an email at taglivingloud@gmail.com. In the meantime, risk manage, live loud, and just smile every day.